Welcome back to the vlog. We are going to jump into the remainder of chapter 3, Trade What You See, Market Sentiment. So we're at like the end of this chapter, so we're gonna finish it in this video. All right, so understanding confirmation bias and anchoring. Technical traders like to think that technical analysis is the antidote to the threat of emotions pushing you to make bad trading decisions. And yet rational, slow thinking is still contaminated by bias. In technical analysis, the minute you put support and resistance lines on your chart, you're framing your perception of the price move. The lines themselves are like a frame around a picture, and you can't see outside the frame. You can't avoid looking at how far away the current price is from support in a falling price situation. In reality, outside the frame is a previous low that the current price trend may be targeting. Your support line can be easily broken. Looking at only the immediate support line may be a form of confirmation bias, seeing what you expect to see. Consider the following. Confirmation bias arises from belief in hypothesis and expecting it to deliver the theoretical outcome without fail. It's actually a form of wishful thinking, like the police who see some evidence the suspect is the murderer and never looks elsewhere for other suspects. Confirmation bias has a dangerous side effect. You stop gathering information, especially information that might jolt you out of the desired confirmation. Confirmation bias is probably the single biggest shortcoming of the technical trader. The lines and indicators on your chart lead you to a deduction about where the price should go, and you forget that other lines and indicators or a chart on a different time frame would lead you to a different conclusion and a different decision. Another form of the confirmation bias might be seeing that the overall market index is rising and the market sentiment indicators described above are all in fine shape, and failing to notice that your own specific security is circling the drain. Another bit of bias is anchoring, where a person would rather retain something for which the original price was high even as the price falls. Anchoring affects look-back periods in charting. When you paid $100 for a stock and now it's priced at $50, you can't help imagining it should be $100. It's a slam against your identity and worth for the darn thing to have fallen so far. And instead of selling the security that just cost you a 50% loss, you hang on to it because if it was worth $100 when you bought it, it's supposed to be worth $100 again. Another example is when the pound sterling falls from an average of $1.65 for a decade to $1.30. It's hard to reset the anchor in your mind that $1.65 remains the benchmark and $1.30 is low. If you believe in reversion to the mean, you can't avoid imagining the pound must rise. This is just one of many reasons why the choice of time frame to display on any particular chart is critical. Being aware of potential errors. When conducting chart-based trading, you're under time pressure, seconds count. Nearly all traders are fast thinking and become at risk of Kahneman's severe and systematic error. Kahneman or Kahneman, one of the two. Fast thinking is intuitive and based on first impressions. It's fast and it takes seconds. And when the fast thinker is an expert, having put in many long hours of study, fast thinking is often right, although it risks jumping to conclusions. Expert insights are a wonder of the human brain, but a practice of intuitive fast thinking can close a person's mind to ridiculously obvious facts or alternative solutions to problems. In the invisible gorilla experiment, a group of subjects watched a video of two teams passing a basketball around and were tasked to count the number of passes by one team. During the video, a gorilla comes into the middle of the scene, thumps his chest, and leaves after 9 seconds. Half the subjects failed to see the gorilla. Clearly, human perception can be distracted to the point of blindness. Another error is becoming so overjoyed at identifying a trend that you leap to the fast thinking mode of making the trade without calculating how much money you'll lose if the pattern fails. Even if you're right and the trade makes money, it was still an irrational decision. And if the trade loses money, you'll gloss over the loss in your memory until it fades to nothing. What's left is more of the confirmation bias. You saw what you expected to see, and the trade did in fact make money, but you think you have made a friend, the crowd, when all that happened was you got lucky. In fact, you're now a victim of groupthink. A great many other people saw the same indicators you were using and executed the same trade. Because it was a profitable trade this time doesn't mean it will work next time. In part because of all the indications you didn't see on the same chart. You may find it comforting to think that you can find regularity and orderliness in charts using the technical methods that take up most of this book, or the sentiment statistics pertaining to the market at large described in this chapter, but don't get too comfortable. Thinking scientifically. Technical analysis is a form of data science, but making a good trading decision takes more than just data, especially when your eyes are going to betray you with the confirmation bias and other pitfalls. So you may consider technical analysis more of a decision science, meaning it combines data with other disciplines, especially some amount of behavioral science, insight, and risk management. Even the best indicator fails to work all of the time. Even the best indicator fails to work all of the time. In fact, some of the best indicators work less than 50% of the time, and that's when conditions are normal. The following sections introduce some probability concepts to keep in mind to prevent your own errors of thinking from sabotaging your trading decisions. The goal is to acquire some new thinking habits that will overcome cognitive errors like confirmation bias. All right, humility, conditions, and contingencies. When you hear someone say blue widget has a 75% chance of rising, you can assume that 3 out of the last 4 times the technical method was applied, the security rose. The unspoken assumption is that conditions didn't change, but the market isn't a laboratory. Of course, conditions changed. The forecast needs to be qualified because of thousands of factors that may come along and influence the price. Contingencies are things that are possible but not expected, or not expected in any great number at the same time. You know what a contingency is, like hitting every red street light on the way to the train station to catch the 609. If you hit the average number of red lights, you can make it on time to catch the train. If they're all red and you also have to slow down for construction, you miss your train. When you hear a promoter predict a price change with a 75% probability, chances are he's talking through his hat. He may have failed to incorporate all of the reasonable contingencies, or he may have attributed too small a probability to any of them or to all of them. Read financial history and you find the ground littered with the corpses of traders who failed to include a key contingency in their calculations. Unlike promoters, most technical traders hate to attach a probability to a particular outcome, like blue widget has a 75% chance of rising. Reluctance to apply the term probability is due to a realistic assessment of the contingencies. In statistics, when you want to calculate the probability of 2 events happening simultaneously, called joint probability, you multiply their probabilities. Multiply. If you have 2 remotely possible contingencies, each with a probability of 10%, the chances of both happening simultaneously is a 10% times 10%, or 1%. Returning to the 75% chance blue widget will rise, assume a single 10% contingency. To calculate the effect of a 10% probability contingency on your trade, you take the reciprocal of the probability, or 90%, as the amount to modify the 75%. In arithmetic notation, it looks like this: 75% times 95 or 90% equals 67.5%. In other words, introducing just one contingency reduced the probability of your outcome from 75% to 67.5%. And wait, it gets worse. If you have 4 contingencies and you attribute a 10% chance to each of them, the same process reduces your 75% odds to a mere 49.21%, which is less than 50-50. So joint probabilities are a real bummer and are the real reason honest technical traders hate to declare a forecast. The more contingencies you admit, the lower the probability of the outcome. Better to look at it than not. All right, sample sizes. Statisticians say you need a minimum of 30 cases before you can say anything valid about the probability of history repeating itself. Scientists who do really serious science, like missiles and moonshots, demand a minimum of 200 cases. In setting up the blue widget example in the preceding section, I attributed a 75% chance of the price rising because 3 out of the last 4 times the conditions looked the same. That's what happened. But a sample size of 4 instances is hardly significant. Your price data seldom presents you with 30 identical cases, let alone 200. Why should you accept less? The answer is that you're using a technical analysis method that works across a wide range of securities and time frames, even if you don't have enough cases in this specific security. For example, when you have a support line and your price breaks it to the downside, that's a sell signal. Over the past 100 years, technical analysts have used the same break of a support line millions of times, and it worked in a majority of cases. Using this method was the correct trading decision, although using the break of a support line as a signal doesn't work every time. A support line break is an example of a technical forecast that has a high probability in the context of many different contingencies and over many sets of conditions. Other techniques are less reliable. You may think it would be wonderful to have a list of techniques with their reliability quotient, or a ranking of how often they're right. Some writers and software vendors claim that their techniques are 95% correct. This lofty proclamation is never true. For one thing, the vendors aren't considering new contingencies and conditions. Markets are dynamic. Something that worked 95% of the time in the past may have worked because a rising tide lifted all boats, and may work only 65% of the time in the future time frame, or rather just in the future. In fact, it may not work at all in a true mania or panic. And that is the end. And when we come back, we'll do chapter 4, gaining critical advantage from indicators. I love it. See you next time.